I know you've been watching this U.S.-Japan trade agreement pretty closely, and you are cautiously optimistic. Why so? Because that 15% number looks pretty good.
Yes, it was a surprise to the upside, particularly including the autos within that. But we were pretty close to our base case target prior to the event. And then on the day of the announcement, we actually went above our base case target. And we're now about a third of the way towards our bull case. So the market actually, of course, along with global markets, has moved a long way since early April. And what's key for Japan is whether the earnings actually turn upwards, the earnings revisions turns upwards. Like the rest of Asia, it's actually been in a downtrend this year, whereas the US, as my colleague Mike Wilson has pointed out, has already inflected upwards.
All right, let's talk a little bit more about your base as well as bull case for Japanese markets and bring up two things. Let's take a look at the Nikkei as well as the Topix. You've got the Topix at about 2,900, is that right?
That's right, and then bull case of 3,250. Okay. And I guess the flex on that is whether we actually get the global economy staying stable to actually improving rather than the house base view that it's going to actually moderate through the second half, slow down, because there is always this lagged effect of the tariffs. And remember, even though we're getting the trade deals, these have been set at materially higher tariffs than the global economy had 2 or 3 years ago. Yeah. And we're going to get that lagged effect on growth, we still think.
Yeah, and a lot of people are looking for that to start hitting probably in the third quarter, right? Let's talk about the pass-through and the impact of earnings. How inflationary they're going to be and who's actually going to pay, right? Whether it's the consumers or the corporates. In Japan's case, we were told by somebody, I guess, a couple of days ago that, look, their car makers are probably the only big manufacturers on Earth which have been lowering prices. Yes. This was ahead of this trade agreement, yes?
Yeah, that's very striking. What's actually happened is that Japanese exports this year to the US and some other geographies have actually been falling off, but they've been growing very strongly into places like the Middle East or selected geographies like Spain or the UK and Europe. So actually, again, this is a sign of corporate sector flexibility, which is very much a theme, trying to figure out this complexity. For the time being, the rest of the world is not tariffing each other. So though there's an EU-China discussion ongoing right now, you haven't got this kind of trade, let's say, trade dynamic playing out on a global basis. It's really the US trying to cut these deals to change its own trade situation vis-a-vis everybody else. Yeah.
So the Japanese car makers, are they the exception? What about other Japanese companies? Do they have, are they eating the tariffs as well, or do they have pricing power?
It's most visible in the auto sector. Obviously, there are some parts of corporate Japan where you've got like idiosyncratic bullish themes ongoing, particularly the defense sector, which is a thematic across Asia, and obviously the AI and AI capex related themes. So it's a very complex global macro situation. It's amongst the most complex that I've seen in my career.
Indeed. Sherry?
Yeah, what about South Korea, Jonathan? Because we've got Commerce Secretary Howard Lutnick talking to CNBC just overnight. He sounded like the Trump administration is trying to sort of, pit Japan against South Korea, trying to get more out of both countries. And if you look at the tariff levels from the deals that we are seeing so far, that it's really similar levels for similar types of economies, perhaps. So 15% likely for North Asia. I mean, it might be a little early to say, and 19% for Southeast Asian countries. What is the market implications coming from that? That perhaps the supply chain implications stay the same, except for the level of tariffs?
Yeah, I think that's a really interesting topic, and it's amongst the first things that clients asked me after the Japan deal earlier this week was, is everybody else going to get the same kind of deal, including not in Asia, but also the EU, for example? I actually think that's quite unlikely. Remember how large the Japanese economy is, and that Japan is a core security ally of the United States in Asia. And of course, Japan also committed to this enormous $550 billion investment pool into the United United States. Japan is the largest FDI investor in the US currently, about $750 billion, and they've committed to grow that by about 80%. It's very, very hard to see smaller geographies like Korea and Taiwan, let alone the European Union, being able to do those kinds of deals with the US. And I think that's why the President of the United States was so bullish on the Japan deal in particular. So, let's see. But I do think it's somewhat unique what happened for Japan.
And it's somewhat unique what happened to South Korea earlier this week. I mean, as the finance minister, the deputy prime minister of South Korea was about to get on the plane, he got the notification that Treasury Secretary Scott Bessent has some urgent schedule. Does that bode not well for South Korean equities? I mean, I know that it's not all about tariffs. It's really the low valuation and so on. But tariff situation could actually hurt some of the upside that this market has seen. I mean, the Kospi is sitting higher by 33% year to date.
Yes, though it had a very bad year for performance last year. So, yes, the value outperforms is something we're broadly bullish on in relation to Kospi and Korea. And certainly we've seen that, and we've been involved in that in our recommended focus list through the financial stocks in particular in Korea. But I do think there is an issue here that Korea economically and in terms of the sector composition of the market, it sits between these two Asian giants, China and Japan. And that's not a particularly good place to be over the medium to long term. So the challenges are significant.
What about this China differential that you point out in your report as well? So basically, higher tariff on goods, but higher tariff on goods that are believed to be coming from China. So in some sense, it doesn't really change the supply chain dynamics. It's just a higher tariff. And I know that it sounds very similar to my earlier question, but is there a market implication coming out of that?
I think you're referring to the transshipments restrictions in the US trade deals. Yeah. So, I mean, that is interesting, and it's somewhat innovative, and it's clearly an issue for geographies like Vietnam in this region and Mexico. And I think the president has also talked about renegotiating USMCA next year. So, again, there's a lot of uncertainty still on the trade side. And the point that our economists make is that uncertainty tends to delay CapEx. So there's the kind of potential inflationary consequences through the supply chain, but there's also the effect on CapEx, particularly geographic distribution of CapEx, that this uncertainty brings.
Why are you overweight Singapore?
Yeah, so we recently wrote a piece, Singapore at 60, and essentially we've documented an improvement in return on equity here in Singapore that is really quite striking. So ROE has gone from high single digits to around 12% in the last decade or so, and that's led to a steady and entirely logical re-rating of the market. And Singapore as a geography is what we call a sort of hub of hubs. It's sitting here with key advantages in relation to obviously traditional industries like energy, essentially the shipping industry, but also it's highly advantaged in terms of new areas like AI data centers and other more knowledge-intensive industries. And it's a very strong story. And the Singapore market has been now a structural outperformer of Asia over the cycle, which it wasn't in the past. So it's doing well this year, but it's also done well during more challenging environments.
Yeah, we can sort of pull it broader and also take it up to 30,000 feet, right? That Japan trade deal, 15%, maybe we're going to get half of the 30 and 15 for the EU as well. I don't know. And we were just talking about Korea. But, numbers like this, one of the reasons why I think Western markets, including Wall Street, are trading where they are, right? Price for perfection and record highs. But a lot of people are standing back and saying, look, I mean, let's not talk about the conflicts going on around the world, but just on the trade war and tariffs, it could have been worse is not a good basis for markets up at these levels. What do you think?
Well, we have also in the US specifically had one very major positive, which is the big, beautiful bill getting passed, and probably a little bit quicker than people had thought. And, that has certain things that are really quite good from a corporate perspective, particularly accelerated depreciation allowances. And the dollar weakening trend also helps US multinational earnings. So 2 months ago in May, we did something at Morgan Stanley that was probably a little bit controversial at the time. We actually put US equities as our major overweight. And we were essentially saying that the US market was going to lead. And that's exactly what's happened. Europe and Asian markets, broadly speaking, have been underperforming the US. It's the US that's making the move forward.
Interesting. And how does Asia look now in terms of A, value, and in terms of earnings growth versus DM?
Yeah, so the S&P on consensus is a little bit over 21 times forward PE, and that's approximately where we think fair value is. So my colleague Mike's target for S&P is 6,500, and that's a target he's had for quite a while. And as I mentioned, we're just passing beyond our base case targets for Hang Seng and Topics. If you take Topics, for example, we're on 15 times forward PE. That 6 PE point discount is perfectly normal for Japan versus US. So when we're talking about being close to targets right now, we're not seeing enormous dislocations. The opportunity clearly was in late April, early May, maybe a little bit less so now.
So these markets pretty much are already there, and Singapore able to get their ROE up to the low double digits is good news. But that's where Japan is at as well, right, in terms of ROE now.
That's right, and that's our framework. We think the market ultimately rewards sustainable ROE and ROE improvement, and Japan has been on that journey. That's something we highlighted for the last decade or so, and we've been pointing out in this recent piece that Singapore also has that characteristic. Now, it's not obviously true of every market. For China, there was a big reduction in ROE, which has most recently stabilized, but that's key to our analysis. Gotcha.